Hi, everyone, and welcome back to Mission Success Women in Multifamily, the monthly podcast series dedicated to powerful female leaders in the multifamily industry. I'm Laura Calugar, Senior Editor with Multi-Housing News, and you're listening to the July episode. Amid the ongoing economic uncertainty, there's one asset type for which demand has only increased over the years: manufactured housing. Crow Holdings is aggressively investing in the sector, having recently acquired a 46-property portfolio. Kristin Millington, Director of Manufactured Housing and Self-Storage at Crow Holdings, is here to share her perspective on why manufactured housing continues to be a highly sought-after investment. Hi, Kristin. Thank you for joining me.
Hi, Laura. Thanks so much. Thanks for having me.
So, a very widely known fact, everybody knows this, there's a staggering affordability gap across the country. What role does manufactured housing play in addressing the affordable housing crisis in the U.S.?
Yeah, you're certainly right. The affordability gap is something that is a hot topic of conversation right now. It's something that we certainly talk a lot about. And I think that manufactured housing is one of the most viable and most scalable solutions to fix the affordable housing crisis in the US. And frankly, I think it's one of the most underappreciated and overlooked solutions that really is right in front of us. What most people don't think about is today's manufactured homes aren't the mobile homes of decades past. I always say that you could walk into a new home blindfolded and it would feel like a stick-built home. They are built to rigorous standards. They're built in controlled factory environments in a day. It's actually a really fascinating process to watch. And so from a cost efficiency standpoint, manufactured homes cost significantly less to build, like 30 to 50% less per square foot than traditional site-built homes. And so that price differential enables both homeowners and renters to access quality housing at a much lower total cost. And so I think that's a model, that really aligns affordability without sacrificing a quality of life or livability. From an investment perspective, this has proven to be a stable cash flowing asset class. Compared to other product types, and particularly other housing types, you tend to have much lower turnover and much higher occupancy rates. And kind of taking a step back, when I talk to our investors, I always want to explain how the investment works. So we, as the investor, own the land, the infrastructure, the roads, the clubhouse, the amenities, and the resident owns the home. And so unlike renting an apartment, which by the way is typically much more expensive on a monthly basis, this allows families to build equity in their home while being a much more affordable option than a traditional home. And I would say any part of the country that you go to, manufactured homes are, I think, one of the few remaining places where an individual can own a home for under $100,000. And so for that, from that sense, think about what demographic manufactured housing is serving. It's serving working families, it's serving seniors on fixed incomes, individuals who earn below an average income in an area, but those groups still want to own a home. And so while I think it's not the only answer, manufactured housing is one of the most scalable, most proven, and most immediate tools that we have to close the affordability gap.
Mm-hmm. And are there any particular markets that are more attractive than others for manufactured housing from an investment standpoint today?
Sure. I would say across all product types that we invest in here at Crow Holdings, we're focused on markets that have diversified economies, they have strong population growth, and markets with robust job creation. Now, the added layer that makes a market particularly compelling for manufactured housing combines those fundamentals, but we also look at constrained housing supply, markets where the cost of housing has continued to run out of reach. We've especially seen that in certain markets in a post-COVID world, and markets where we see a favorable regulatory climate. Right now, we're seeing strong investment opportunities across a few key regions. I would say, especially the Southeast, select Sunbelt states, parts of the Midwest. Take states like Texas, Florida, Georgia, the Carolinas. people are moving there in droves. I always think one of the most interesting statistics is the list of one-way U-Haul moves. I think that's an interesting metric. And those states continually show up on that list, but housing development hasn't kept up in those states. And so you see a little bit of a housing shortage there while you see strong in-migration. So kind of coupling the fundamentals that I listed above together. Secondly, a lot of these areas have more favorable regulatory environments for land use and zoning, which is particularly important in manufactured housing. In places like, Georgia, Alabama, for example, there's oftentimes more openness to manufactured housing communities compared to coastal markets where permitting can be, frankly, a nightmare. The Midwest, I think, is also worth watching. States like Indiana, Ohio, Michigan, we've seen good opportunities. In those markets, you see strong blue collar employment bases. You see, a lot of industrial employment there. You see an aging housing stock. And so I think those markets, make that ripe for both affordable housing options on the development side, where zoning may be less stringent, but you also see a huge stock of older communities owned by, the legacy mom and pop operators. They haven't optimized rents. They haven't optimized operations. And then lastly, I think something that we look at in manufactured housing is more secondary markets that might be on the outskirts of a major metro. But I think in those smaller, cities and towns, you still see a stable demand. You still see a long-term tenant base, but you also see from an investment standpoint, a lower cost of entry. And so you realize strong cash flows from day one. And so ultimately, I think the most attractive markets share a few key characteristics: strong inbound migration, supply constraints in traditional housing. And I think the added layer here is some sort of regulatory framework that either permits or doesn't overly restrict manufactured housing.
Mm-hmm. You have a lot of experience in the sector. You've been in the sector for years now. What has been your most rewarding experience leading investment activity in this sector?
Oh man, great question. Our bread and butter really has been focused on acquiring existing communities from mom and pop legacy owners, where in many cases, they haven't reinvested into the community in years. I'm talking 10, 20, 30 years. And so one of the most rewarding experiences we have on our team is taking over these struggling, underinvested communities and turning them around, not just financially, but culturally as well. We
Mm-hmm.
invest under a value add fund vehicle. And so we always underwrite a pool of capital to come in and improve infrastructure, repave roads, add clubhouses, add playgrounds, you name it, just generally improving the quality of life. We bought a community a couple years ago in Florida where the residents were actually pooling their money together to make improvements themselves. And so if they wanted, to see changes at the pool, they pulled their income together and they did that themselves because they had a disengaged owner. We bought another deal last year up north in a cold climate. The community manager had been on site for years, but she didn't even have a heater in her office. We don't own the homes, but in most deals that we buy, we'll host community cleanup events where we'll provide paint or tools to fix up the home. I was actually in a community at one of ours that we own in Montana a couple of months ago, hosting a community barbecue to unveil a new clubhouse. And it was really rewarding just to talk to the residents and get to know them and hear how they value and like what we have done. And so I know that's a lot of small examples, but it's a reminder that, we're not just, unlike other asset classes, you're not just managing assets. You really have a hand in shaping the neighborhood and shaping the community. And that piece has been really rewarding for me.
And are you seeing more institutional investors showing increased interest in manufactured housing? And if so, why do you think they're more and more interested in this asset type?
Oh, absolutely. I mean, we started looking at manufactured housing in 2016, 2017, and you've even seen the conference attendance change in the past 8 years. Not that conference attendance is a great barometer of institutional interest, but I am always surprised at how much the space has changed, even in that sense. Institutional interest in MH has grown significantly over the past few years. What was once a niche mom and pop asset class is now firmly on the radar of, private equity firms, REITs, pension funds. Our investors have certainly taken an interest in the space. Laura, I think the fact that we're even, talking on this podcast shows
Right.
that shows that there's institutional interest in the space. So why is that? First, there is a solid macro story. If you look back over the past 20 years, the manufactured housing sector has generally seen positive NOI growth. I want to say there's actually not a year that the REITs have reported negative NOI growth. Now, during that time, we've seen the GFC from 2008. We've seen the COVID pandemic. During each of those down cycles in manufactured housing, rent collections have remained stable, turnover has remained low, occupancy has remained high, rents have continued to grow. And so we say that it's a cycle resistant asset class, but you have the real data to show that, which of course institutional investors love. So the fundamentals are strong and they're getting stronger. Housing is not becoming more affordable, and still the housing stock in MH is shrinking. We have very few parks built because of zoning challenges. And so you have a sector with tight supply, you have inelastic demand, and so there's some, inherent built-in scarcity value there. Those fundamentals have kept a lid on cap rates, but still, I think MH offers very attractive risk-adjusted returns where investors are looking for stable income, they're looking for lower operational volatility, and they're looking for some downside protection, which we've proven through cycles that you get in this asset class. And then lastly, ESG has become more of a focus for our investors and for institutional capital in recent years. It's becoming a bit of a buzzword and something that we're really focused on. And in my opinion, MH offers long-term ESG upside. You can deliver affordable housing at scale. You still get competitive returns. And so I think that's a pretty rare combination. So yes, capital is coming in. I certainly don't think it's a passing trend. I think we will continue to talk about MH being a core part of the affordable housing strategy. And I think that institutional capital will continue to recognize that, and we'll see capital flow into the space.
Are there any innovations, whether in construction, financing, or management, that you believe could transform the MH industry going forward?
Yes. And I think, in fact, that we're on the cusp of a transformation across all three areas that you mentioned that could really reshape the landscape in a very real way. Since you mentioned those three in particular, I'll take a second to touch on each. On the construction side, I'll start with that. I mentioned it earlier, but the manufacturing process is getting more and more efficient. These homes are built in a day. You don't have weather risk. You have less waste. It is a significantly more efficient building process than a stick-built home. They're delivered, call it, 70% faster than site-built homes. And so the speed at which you can build, deliver, and set a manufactured home makes them very ideal, I think, for addressing the housing shortage quickly. Now, that being said, I think what will become more important and where I want to see more innovation is in zoning and land entitlement reform, If more municipalities embrace manufactured housing, by revising outdated zoning codes, by allowing manufactured housing as part of the residential zoning, we could unlock tremendous potential to bring affordable housing development to, both urban and rural markets. Secondly, on the financing front, the access to competitive lending has historically been one of the biggest challenges in this space, and that's for homeowners, developers, owners alike. I think that's starting to change. Fannie and Freddie are a big source of liquidity on the debt side, and under the new administration, it feels like the agencies seem to be more active this year, which I think is positive. I think as the agencies continue to expand their manufactured housing loan programs, both on the investment and the home sales side, we'll likely see more liquidity and in turn, more investor confidence in the space. For homeowners in particular, financing continues to be a very limiting factor. These homeowners typically depend on chattel loans as opposed to traditional mortgages. They're often unable to access the traditional 30-year mortgages that we see on stick-built homes. And so not only does that hurt homeowners, it also slows home sales to make developments difficult for investors to pencil. And then lastly, on the management side, we're seeing a lot of ways to optimize operations at our communities. We're seeing things like online and mobile payment platforms so they can pay rent online versus dropping off the check to the front office. We're seeing platforms to, request maintenance and types of digital maintenance tracking. We're seeing resident engagement apps, which have become very important. Another value driver that we've adopted in the past year or so is bulk internet for our community residents. That's really leveraging what we've seen on the multi and student housing side. But we can basically sign these bulk internet agreements with internet providers at wholesale rates. And what that does is it allows tenants to opt in at pricing that makes us a few dollars, but it still results in a lower rate than they're currently paying for internet. So really, it's a win-win for everyone. Um, on the management side, each of these tools don't just improve efficiency, they really enhance the resident experience, which in turn helps with retention. And at the end of the day, it ultimately helps with long-term value creation. So yes, and innovation is happening. I think the future of manufactured housing will be more efficient. I think, similar to all sectors, I think we're seeing everywhere, we're becoming more technologically advanced. But I think if we continue as investors to think about these innovations in tandem with thoughtful investment and policy advocacy, the industry will continue to grow and ultimately will evolve into one of the most important pillars of housing in the U.S.
Mhm. You mentioned the resident experience, and I'd like to know, how do you think resident needs and expectations are changing in manufactured housing communities? What do they want nowadays?
Sure. I think what we've established, in the past 20 minutes is that housing costs are simply outpacing income growth. For many working families, retirees, first-time home buyers, the dream of owning a traditional stick-built home is no longer realistic, especially in growing metros or suburban markets. It's certainly what we're seeing in Dallas, but residents don't want to settle for less in terms of quality and comfort. So what residents are looking for now is a home that offers the look, feel, permanence of a stick-built home, but at a dramatically lower price point. And that's exactly where modern manufactured housing can fill this need. I touched on it earlier, but you can go in a brand new manufactured home and it doesn't feel different than a stick-built home. And with housing becoming less and less affordable, I mean, I don't know about your first starter home, but I don't think I could afford a starter home now, but I still want that quality. And so in addition to the quality of the home, I think one of the most noticeable shifts that residents are looking for today is a sense of community and a quality of life. I think that's something good that came out of the pandemic. We always talk about it. When people were working from home, they were spending more time in their neighborhoods. We would go on walks to take calls and you met your neighbors and there was a sense of community. And so I think part of delivering that experience is recognizing how expectations around amenities have changed. If you look at what's happening in the multifamily space, it has become an amenities arms race. When our multi guys bring an a deal to investment committee, these developers are adding dog parks, co-working lounges, pickleball courts, sand volleyball, outdoor gathering spaces, you name it, someone has thought of it, right? And so while manufactured housing communities may operate at a different price point, the desire for lifestyle features is still the same. And so we're seeing our residents respond very positively to just simple, thoughtful amenities, things like putting greens, dog runs, clubhouses, outdoor common areas, even just reliable internet and an updated utility infrastructure. These things don't have to be high cost additions, but they signal care and they signal pride of ownership. And I think it makes residents feel like they're part of something. They're not just, renting a lot that their home sits on, they are living in a neighborhood. Transparency and communication have become very important. Residents want to feel heard. They want to feel informed, particularly around rent changes, around changes in community rules. And so I think operators who take the time to build trust, to treat residents like they're valued stakeholders and not just tenants, are the ones who will succeed in the space. And so at the end of the day, The residents want what anyone wants. They want stability and they want a place that they're proud to call home. And so the operators that can meet those expectations while keeping the housing truly affordable will be the ones that are, I think, winners in the long term.
You have a lot of experience across multiple real estate functions. Has your perspective on manufactured housing changed over the years? How do you expect the sector to perform over the next couple of years?
Yeah, something that I think we do really well at Crow is we leverage economists and we leverage our in-house research team to follow, the macro secular trends. And we use those to really drive our investment strategy and drive our target allocation. And by doing that, we identified manufactured housing as an attractive asset class early on in 16 or 17. And during the majority of my career at Crow, I focused on what we call our niche sectors, self-storage, food and service retail, manufactured housing, to name a couple. And I think our perspective on these niche strategies and more specifically manufactured housing has shifted. We still view it as a specialty asset class, but now we see it as one of the most strategically important and resilient sectors in the entire real estate landscape. When we got into the space, manufactured housing wasn't a major part of institutional conversations. It was perceived as low quality. It was operationally messy and inefficient. The small deals were difficult to scale. Well, by now we've invested in over 135 of these communities, and we've seen firsthand the resiliency of the sector. And I go back to the supply and demand imbalance that we see. I think it's one of the most unique supply and demand stories that we see in real estate. In all of the product types that I've touched, this is the only one where you don't worry about the threat of new supply. The supply demand imbalance is massive and it's getting worse, but manufactured housing can offer a real solution to that at a lower cost and at a faster delivery timeline than almost any other option on the market. Looking forward, I actually just read an industry publication. It's one that a lot of your listeners probably read as well. And it said that manufactured housing is projected to outperform all other sectors over the next 3 years. And I really agree with that for a few reasons. First, demand is locked in. Interest rates remain elevated. Home prices are not going down. I actually saw an article in the journal recently that said the average home price in the US is $430,000. Now, I don't know about when you were 22 and trying to buy a home, but my starter home was a lot cheaper than that. And so I think people will continue to look for a more affordable path to home ownership. On the supply side, I remain optimistic and hopeful that zoning and land use policies will gradually ease. But even if that does happen, new supply will be slow and it'll take time. The development timelines, the infrastructure cost, the local resistance that will still be there, all make this a long process, which is why existing communities will remain incredibly valuable for years to come. And so that negative supply dynamic will continue, and the demographic tailwinds for this space are so strong. And so I think that bodes very well for manufactured housing going forward. Being involved in multiple verticals has helped me see that the strongest opportunities often lie in kind of the under-innovated, under-the-radar sectors. And I think our house view has evolved from a cautious curiosity and a white paper that we put together in 2016 to full-on conviction. Manufactured housing is becoming no longer a niche sector. It's core, it's durable, and it's an asset class that I really believe will play a leading role in the next era of real estate investing.
And are there any specific trends in the sector that you'll be watching closely going forward?
Yeah, since we've been in this space, our strategy has really focused on stabilized acquisitions. But if you can't tell from our conversation, we would love to be more active on the development side and bring more communities to market. So in that vein, one of the most critical trends that we're watching is the gradual shift in zoning and land policy, particularly at the local and state level. And, coupled with that is changes in financing. We're keeping a really close eye on markets where local governments are simplifying entitlement processes. They are doing their part to reduce the NIMBY resistance that we see They're working to reclassify manufactured housing as compatible with residential zoning, because those are the places where new development, I think, will move forward most efficiently. At the same time, financing conditions are just as important. Even if zoning improves, development can't move forward without capital that makes sense. And right now, we have higher interest rates, we have tighter credit, and those are a big part of the equation. Now, I do think there is a sense of stabilization and optimism towards a couple of rate cuts happening this year. And so I anticipate that we'll see more consistency in underwriting and deal flow this year. But we're really keeping a close eye on financing conditions. The other thing that you have to think about on the development equation is your ability to sell homes. Remember that pad rent is driving revenue and driving the value in the investment. And so equally important to financing the development is financing at the resident level. So we're watching for reforms in home financing, and particularly any movement towards longer term, lower cost chattel lending. If that becomes more widely available, then it can significantly increase the volume of home sales across the communities, which is not only good for residents, it's important for institutional investors as well. The more affordable home financing you get, you improve absorption rates, you support occupancy, ultimately it helps new developments pencil. So for us, ease of development is a major focus. Any changes that can reduce friction in that process, we're focused on. We think that can open up some attractive opportunities. And then the other issue that we're laser focused on right now is the growing focus on resident protections. Rent control proposals have started to pop up in headlines more frequently. You're starting to see increased media scrutiny around large-scale manufactured housing ownership. And so while the intent behind these efforts is to preserve affordability, the implementation can vary widely. And so we're extremely mindful of states and municipalities that are pursuing these, rent control or very restrictive tenant legislation. Now, don't get me wrong, we fully support affordability. That's why we're in the space. And we certainly don't want to price residents out. That's never our mission. Responsible ownership is very important to us. But rent control can severely limit the ability for owners to reinvest in communities, to maintain infrastructure, to ensure long-term viability. And so we're very cautious in deploying capital in these rent control jurisdictions. I said it earlier when we discussed markets to watch, but we're certainly more bullish on states where there's a more balanced regulatory environment, where affordability can be preserved through market-driven approaches and not artificial rent caps. So I think manufactured housing, has a very strong runway ahead, but thoughtful market selection, policy awareness, those will be more important than ever.
Kristin, thank you very much for taking the time to speak with me.
Thank you so much. It was great being on.
Thank you all for listening. The next Mission Success episode will come online on the third week of August. But until then, you can check out multihousingnews.com for the latest news, feature stories, and podcasts. And I also encourage you to subscribe to our recently relaunched YouTube channel. Till next time.